Hi, I'm Angie Austin with Oil and Gas 360, and we're at EnerCom's 2016 Oil and Gas Conference, and we are joined this morning by Hal Chappelle. He is the President and CEO with Alta Mesa Holdings, and you are back again this year. Welcome,
yes.
Hal.
Thank you.
All right, this is quite a doozy of a question.
All right.
And so are you ready? I know you've glanced at it, but it's a doozy for me.
Okay.
It's a lot of information, very specific to
Okay.
Alta Mesa Holdings. All right.
Yeah.
Overall company production volumes of 2,200 BOE per day in the second quarter were up 6% compared to Q2 of last year.
Right.
Production from your Sooner Trend stack play assets, that was up 45%.
Yes.
And your stack production amounted to 60% of the company's daily last quarter. So, could you talk about your stack assets and the ramp up of production and what your plans are for the play going forward?
Sure, thank you. So the increase in production, I think, has a little bit more significance in that we had sold our Eagle Ford assets between second quarter of 2015 and today, and that would have been another 2,000 barrels a day of Q2 15. So it just means that it's that much more significant growth than what we actually have. But where the real growth has come has been in this area that the industry is now called the STACK. And STACK actually stands for Sooner Trend, Anadarko Basin, Canadian and Kingfisher County. It's an acronym that helps people understand,
right.
But it also is very descriptive of these multiple formations that are stacked,
yeah.
And that you get to drill wells into with new technology that our industry has been able to put together over the last decade and profitably extract the oil and gas there. So, so our operations in the Sooner Trend stack area are, right now we have 4 rigs running. We have over 92,000 net acres, and that's a good position. And it allows us to be efficient with a good foothold there to understand the acreage. It's the most important thing, understanding what works, defining the resource, and then determining how to best develop the resource. How many wells are going to be needed to efficiently and profitably drain the oil and gas so that we can get that up and get it into the marketplace. And so our task right now is primarily having effective operations to define and begin the development of this resource. Now when we say that, I look at this as a very early stage of development in the stack. If it was a baseball game, I think we're still in the first inning.
Yeah.
We have a lot more to go, and we and other of the industry participants are probably going to drill thousands of wells eventually where we'll be able to profitably extract the oil and gas there.
All right, Hal, let's talk Alta Mesa's other producing asset, Weeks Island, Louisiana. Average daily production there in the second quarter was 3,900 BOE per day, 90% oil. Can you talk about that asset, how you manage it, and your plans there? Yeah,
it's a great part of our portfolio. The history of our company and many other companies is what we would call conventional resources, where they're sandstones or even limestone resources where you drilled vertical wells and you completed those and allowed the natural forces of the earth, if you will, the pressure to pull that oil and gas up to the surface and force it up there. These, as opposed to a resource play like the stack, where we're going in with this much more extensive drilling that's widespread. So we're targeting smaller, what we call reservoirs that are sandstones at Weeks Island. So Weeks Island was originally developed by Exxon and Shell in the 1960s. It's produced almost 500 million barrels of oil equivalent. And today we're producing, as you indicated, about 3,900 barrels a day. It's an important part of our portfolio. We haven't been drilling for almost 2 years there. What we've been doing is managing the wells, managing the facilities, optimizing the production in those wells, and really trying to manage the cash flow so that when prices do improve, we can have a very efficient field in which we can go back in and drill wells in a better market environment.
All right, let's talk about production costs. Your production costs were down 10% for Q2 of 2016 compared to the 2015 second quarter. Do you expect costs to continue downward, or are you getting close to bottoming out with cost cutting and efficiencies?
Yeah, it's a great question, and we're in control of part of that equation. If the market, say, returns to a higher price environment, there may be more competition for services, right? So say hydraulic fracturing crews or drilling rigs. And so part of our cost structure is probably going to be affected by some of those in the future. But what we can control, we think there's still a lot of room to cut costs. One of the great things is that where we're concentrating our capital is in the Sooners Trend stack area. And as I indicated, when we get into this more development mode where we're drilling multiple wells per drilling unit, which is essentially a section or a square mile, where we might drill anywhere from 4 to 16 or more wells. When we can share facilities, share services for those individual wells, there's efficiencies that are going to be gained. And if we're smart about the way that we configure our surface facilities and the infrastructure, we'll be able to bake in even more cost efficiencies.
Excellent. All right, Hal, let's talk about how is Alta Mesa positioned to succeed if we end up with an oil price in the 40s that lasts, for example, through 2018?
Yeah, that's another good question, and we only have to look to the experience that the industry has had, and in fact our whole economy has had with natural gas in the Marcellus, where the great strides in actually drilling and completing wells turned into this massive resource of natural gas that is available to our economy at very, very good prices historically, right? So consumers benefit.
Yeah.
Well, but from a producer standpoint, you have to succeed in a low price environment.
Right.
Well, similarly, if it's $45, we've got to be the low cost producer. And what we've been able to do by focusing our capital in the stack, and then actually, you mentioned Weeks Island and the fields around there that we have a very good cost structure there too, where we believe we can continue to succeed. Our challenge is going to be to make sure that all parts of our operation, operating costs, our overhead, our service costs, and then the capital costs we deploy stay in this, what today is a very good cost structure that allows us to have profitable well economics even at these prices. Oil's probably about $45 a day. I mean today, I haven't checked it, but it's about that.
And that's what it was yesterday, so I think you're about right. All right, Hal, a key message that you put forth going into 2016 was the focus on guarding the balance sheet and liquidity. Could you update us on those efforts?
So, we've done a number of things over the last several years. We're blessed to have a good private equity partner who's a shareholder. They have a preferred equity stake in our company. Okay. You have long-term shareholders on the common side, the management team. And then when it comes to our capital structure in terms of debt, we have bonds that are unsecured debt, okay, and then we have our first and second lien. Our banks have worked with us very, very diligently and have, and I guess have rewarded us, if you will, by recognizing and affirming our borrowing base. That's an important thing, a revolver balance. And then first increasing our borrowing base last fall, when it was a tough time in the market, and then affirming it again this spring. So we've been able to do that. We also have found a very good mechanism with a great partner to be our joint venture partner in drilling up the stack asset. We have a joint venture with a group called Bi-City Energy Management, where they fund 100% of the drilling costs in a certain number of wells, and we get to participate until they achieve a certain rate of return, and then some of those things, those metrics change. So they win, we win, and it allows us to continue the pace of play, if you will, in the stack in this low price environment. So overall, from the balance sheet, we feel very good about the future. We feel like our options are out there, and we continue to work them. Maybe depending on the circumstances, it could be reconstructing our debt. It could be additional JV. It could be asset sales. We've been able to be successful in some asset sales in the past, or we could actually have additional equity come into the company, depending on what the particular need might be for our balance sheet.
Wonderful. Thank you, Hal.
Thank you very much.
Hal Chappelle, he is President and CEO with Alta Mesa Holdings, and I'm Angie Austin with Oil and Gas 360. Thank you so much for joining us.